Welcome to Alternative Investments Chat,
where we demystify the world of alternative investments and financing for entrepreneurs and investors alike.
With these discussions, we hope you're more empowered to unlock opportunities in your business or portfolio. I'm Erin.
And I'm Erica. Let's get started. Hello, and welcome to another episode of Alternative Investments Chat. I am your host, Erica, with my beautiful co-host, Erin.
Ooh, beautiful.
You're beautiful always. So today we're going to discuss how traditional banks are partnering. They're partnering up, linking up. They're going on Tinder and making new friends with alternative investment firms to create new finance models.
You know what's funny? You said Tinder, and I was thinking about like country dancing. I was like, do-si-do, and you're like Tinder. So that should just tell you something. Anyways, why is this shift happening?
I don't know.
Alternative finance is growing fast. Banks are losing ground to private lenders, actually. More institutional investors are moving into private credit and structured debt deals. We've talked a lot about debt on this podcast.
Yep.
Fintech and alternative lending platforms are reshaping the banking sector, making it possible for these alternative forms of finance to grow.
Exists, yeah. So historically, banks were the primary controllers of lending, acting as the main source of credit for individuals, businesses, and the government, actually. Their dominance in lending, is evolving, influenced by regulations, economic cycles, and financial innovations. So let's take a quick look back at the evolution of the bank. So in the 19th century, banks had near control over lending as alternative financing was obviously underdeveloped.
Right.
Banks dominated corporate and consumer lending in the 20th century. It was during this time, though, that banks began offering home mortgages, car loans, and small business loans. So they'd be giving out money.
Yep.
Then the Great Depression led to tighter regulations to separate commercial banking from investment banking.
Sure.
So between the 80s and 90s, though, we had the credit card boom. And then just like everything, they put regulations on it and then they took them off. So during this time, we had deregulation allowing banks to expand back into investment banking, securitizations, and private lending.
Interesting. So it wasn't until the 1990s that we finally had the emergence of competition. Competition is always good, right? Capital markets, hedge funds, and private equity began competing with banks in lending. It was in the 21st century that banks started losing lending monopoly to alternative lenders. Monopoly, in a capitalist society is a bad word. So this is a good thing. The post-2008 crisis gave way to a rise in private credit. Regulations restricted bank lending, making it harder for banks to finance riskier loans, probably for the best.
Yeah, exactly.
We saw what happened. Private credit funds like Blackstone, Apollo, Ares filled the gap, offering direct loans to businesses that banks couldn't serve.
Yeah.
Peer-to-peer lending, crowdfunding, and blockchain lending began to disrupt the bank's control. People are able to get money from different places.
Yeah.
Fintech platforms, Lending Club or SoFi, allow borrowers to bypass traditional banks. They were able to get the money that they needed, didn't have to go the regular way.
Traditional route, as you like.
Traditional way.
Yeah. We weren't very happy about that. And that brings us to the current landscape of where banks are. So today, banks partner with private lenders, hedge funds, and fintechs instead of controlling all the credit.
Gotcha.
Again, they went back to that partnership. Securitization, syndicated lending, and structured finance spreads risk across multiple players. Again, banks, if you couldn't pay a bank back, they took the hit. Now we've got a lot of different sectors that are handing out money. If they would like to give me any, please let me know. Again, I'm always for free, no interest.
I don't want to pay that.
I'm always down to gather that, right? So let's get over the history lesson here and let's explain to our listeners how alternative financing models actually work, because it's a little confusing.
Yeah. So as we've already mentioned, traditional banking is no longer the only way that businesses and individuals can access the capital that they need. So here are a few alternative financing models. These are not the only ones that there are, but we're going to cover a few. We're not only going to cover what they are and what they do, but why they actually matter.
I like it.
Private credit and direct lending. These non-bank institutions, private equity, hedge funds, asset managers, provide loans directly to businesses. This type of lending targets middle market companies, leveraged buyouts, and distressed borrowers that banks avoid due to regulatory constraints.
Yeah.
And also it's perceived as more risky, so banks typically don't take it on.
Yeah.
Why does this matter? It offers faster approval, flexible terms, and higher leverage than traditional banks can offer.
Nice.
Private credit is actually now a $1.5 trillion market.
Whoa.
That's a big number.
It's a big number.
Yes. Led by some of these names that we know, Blackstone, Apollo, Ares, KKR, right? So there's also securitization and structured finance. Banks package loans.
Wrap them up.
This
put a
is
bow on 'em.
exactly. It reminds me of like the progressive bundle.
Yeah.
You know?
Bundle and save.
Exactly. Because it's mortgage, auto loans, student loans, all different assets that you need money for, need to borrow money for. Bundles those into securities and sells them to investors.
Okay.
This reduces the bank's exposure while maintaining that capital flow. Why does this matter? It expands the lending capacity by moving loans off of banks' balance sheets and allows institutional investors, hedge funds, pension funds, to fund credit markets.
Okay, so those ones sound cool, but I've got a few other ones for you that I think are just as nifty. We've got peer-to-peer and marketplace lending. So online platforms, again, everything is going to your cell phone online. We don't like to talk to people. In fact, I don't like talking
To you
right
now.
I love talking to you.
I love talking to you too.
I feel bad for everyone else who has to listen. So online platforms connect borrowers with individual or institutional leaders, bypassing banks. Again, the poor banks are getting pushed to the side. That's okay. They use AI-driven risk assessment to match borrowers with lenders. They want to make sure that you are able to pay back these loans. Again, like we said earlier, we've seen what the banks did when they were just giving out money willy-nilly. People couldn't buy it back in the day. So why does this matter? So it provides faster tech-driven access to loans, expands credit to underbanked individuals and small businesses. Again, a lot of these businesses can't go to a credit union or a bank because they don't have history. There's no financial history. And so banks like, we good.
No thanks.
No thanks. So again, we've got crowdfunding and tokenization. So retail investors fund projects or businesses in exchange for equity, debt, or rewards. I want to know what rewards are. I want a little bit of everything. Tokenization uses blockchains to fractionalize assets, making them more liquid. Again, that's very, very something that investors really like. They like being able to have their money just in case.
Yep.
So more liquid is always better. So why do these matter? So democratization finance it democratizes finance, there we go, by allowing retail investors to fund private deals. Because again, it's a small piece. You don't have to have a ton.
Right.
It reduces reliance on traditional banks or VCs. Again, those people who want to take all the money, charge you a ton in interest, and then you're forever in their debt.
Yeah.
So those are a few of the models, but I feel like we don't need to continue bombarding our listeners with all of this information. So again, because we could talk probably hours and hours and hours on this, so we'll spare you. You're welcome. Let's talk about the risks and rewards of the bank alternative investment partnersts.
Yeah. I know how much you love risks.
Yes.
So I'll save those for you.
Thanks.
And
So
I'll
kind.
go over opportunities. First, you have access to higher yielding investments. This is huge for investors. Traditional bank lending is low margin and is highly regulated. So alternative assets like private credit, infrastructure, real estate, venture capital, all the things that we talk about on this podcast can offer higher returns.
Yeah.
Also, expansion of private credit and direct lending. Post 2008, regulation limits banks' ability to lend to riskier borrowers. Again, probably a good thing.
Yeah.
Partnering with private credit funds allows banks to offer financing to middle market businesses, startups, and leverage buyouts. Pretty cool.
Yep.
Fintech and blockchain innovation. You touched on this a bit. Banks leverage fintech and blockchain to offer tokenized assets, AI-driven risk management, and digital lending. This reduces operational costs while improving liquidity in private markets. Obviously, as technology advances, we're going to start reaping more of those benefits.
Yeah.
Some of the things that used to be more difficult to do are easier to do, more access to different people who didn't have access before, et cetera, et cetera.
We're letting the poor person in to the wealthy man's world.
Yeah.
With all these.
Yeah, they get a little piece of the pie.
Yeah.
So now I'll hand it off to you for risks.
You're so kind. You're so good to me. So again, there's probably a lot more risks out there. But these ones really stood out to me. So I just want to touch on them. There's always regulatory and compliance uncertainty.
Yeah.
Okay. Banks are highly regulated, as we well know, while many alternative investment firms, they operate with fewer restrictions.
Right.
Again, kind of pushing the bank to the side, no offense, but that's why they're partnering together, right? So there's increased scrutiny on shadow banking and systematic risk exposure. It's just part of it. Reputation and risk transfer issues. So banks co-investing or distributing alternative assets take on a reputational risk if funds underperform or collapse. It is their reputation. So if they don't do good, you're blaming the bank, right? So that's always a risk. And then if you're going through a bank, there could be misaligned incentives because a bank is going to want. We talk about it when we were talking about wealth advisors. You want to make sure that your all of your stuff is aligned with what you want, and not just to give the bank more money.
Right.
If that makes sense.
Mutual best interest.
Yeah, exactly. Because the bank doesn't really care about you. They just want your money and they want that interest payment. There's also competitive pressures and disintermediation. So alternative asset managers are increasingly acting as direct lenders and wealth managers competing with banks again, because they have your best interest in mind. A bank's not going to give you the due diligence that you want. And banks may lose market share as private equity and hedge funds build their own lending platforms.
Yeah.
We're definitely seeing that. Okay. So we've gone over the good, we've gone over the bad and the ugly. And we'll just wrap this episode up because that's a lot of good, bad, and everything else in between.
Yeah.
And we poo-pooed, unfortunately, on the banks. Sorry, banks.
Yeah. Sorry.
Yeah.
So here's a quick summary. Banks are evolving to stay competitive in the alternative finance space. Private credit, structured lending, and fintech are reshaping the financial markets. We know this. We're seeing new technologies change, even, just like month to month. There are different things that come out or we become aware of that are pretty cool and kind of changing the way that people do business in the space.
Yeah.
Institutional investors are blending banking with private credit strategies. This also kind of reminds me of our family office episode where we talked about family offices who are starting to work as general partners. We're seeing like a mesh and a blend of these roles that traditionally have been very separated and isolated. Everybody's kind of learning from each other and incorporating some of those practices into a space where you wouldn't normally see them.
It reminds me of like red wine blends. Like a Pinot is great by itself, a Syrah is great by itself, a Cab is great by itself, a Grenache, all the good stuff. But you blend them together, it's 20 times better.
Yeah. You can get some really tasty wine that way for sure.
Yeah.
And just it'll be interesting to see what technology continues to do in this space. And we'll be sure to talk about those things as they happen.
Yeah, that's absolutely right. Because banks are no longer the soul. Oh, the thing I don't have heard. Okay. They are no longer the sole source of capital. Alternative investment lenders are reshaping, again, those financing options. Strategic partnerships between traditional banks and private markets are opening new doors for those investors. We love opening doors for everybody.
Yeah.
Windows.
Doors.
Sky, moon, what are those things called? Skylights in your car?
Skylights. If you can't get in through the door, go in through a window. That's kind of what's happening here.
I know.
All right. Well, thank you so much for joining us today. Don't forget to like and subscribe. Thanks for tuning in, and we will catch you on the next episode.
Thanks for joining us. Stay tuned for more insight on our next episode.
And don't forget to subscribe to continue the Alternative Investments chat.
See you next time.
Content provided in this podcast is for informational purposes only and should not be construed as professional, financial, or investment advice. This podcast should not be construed as an offer to sell or a solicitation of any offer to buy any securities. We strongly recommend that you seek advice from a qualified professional before making any financial decisions.